Portfolio manager of the Villere Balanced Fund. And Sandy, I think this is important to check in with everybody on first half performance. What about for you guys? Down about 20%. And what would you say about the landscape that we're facing into the back half?
Yeah, I mean, we'd be more excited about putting money to work in high quality names. If you look at the Vanguard Value Index, down about 10% year to date, yet Vanguard Growth is down about 30%. I'm more inclined to buy something down 30% that offers a lot more value, growth at a reasonable price than what you'd find where a very crowded trade has occurred in value names, the staples, healthcare, utility, telecom stocks. I want to really avoid those and start playing some offense here.
What about the argument that some of the growth names are permanently broken? The business models just don't work.
Some are. I mean, let's be honest. Some of these names that came out of SPACs, et cetera, some that don't make money. I would probably avoid some of those names that are not as on solid footing as some of the high quality stocks you can buy that have great cash flow characteristics, moats dug around the businesses and things that are probably going to perform quite well. And what a great opportunity to be able to buy these things, some off 35, 40% that you can put away and make some good money looking out 3 to 5 years.
So Bob was just talking about, kind of the history here, and it's not that unusual to have a period like we've just been through. But what do you think the fundamental case is for a sort of better environment in the back half? And what do you make of rates today as well?
Yeah, so we look at are we going into a recession? That's what we're all talking about. And does this happen at the end of this year? Does it happen next year? And the reality is, we probably do have some sort of shallow recession, and I would argue it would probably be next year. But you were showing some of those stats from 2008, 2009. That feels like yesterday, and that was a scary time. I mean, we lost 11 million jobs at that time. Today, basically anybody that wants a job can have one. Sure, it's going to get a little bit tougher before before the Fed is finished. Raising rates, which we should see here in July, another 75 basis points or something like that. But this is all self-inflicted. When the Fed can finally cool this economy, and we saw consumer spending slow down a little bit, 0.4% this morning, then I think we can get back to some normalcy here. So I think that happens probably sooner than later. And I wasn't that disappointed to see a little bit of a slowdown in consumer spending. That's actually going to help the Fed slow down their rapid rate hikes here to battle the red hot economy.